Welcome to this first chapter of financial accounting. In this session, we are going to build a strong foundation for the entire subject. Before we learn double entry, financial accounting, financial statements, or exam questions, we must first understand the purpose of financial reporting and who uses financial information. This chapter helps you see the bigger picture. Why do businesses prepare accounts and who actually uses this information? So and so on. By the end of this session, you will understand not only the definitions but also why they matter in real life and how they connect to the ACCA financial accounting exam. Learning outcomes. By the end of this chapter, you will be able to define financial reporting. Means you will understand what financial reporting means, why organizations prepare financial statements, and how reporting supports decision making. Identify and define the types of business entities. In this, you will learn the major forms of organizations like sole traders, partnerships, and limited companies, and how each of these ones differ from each other. Identify the users of financial statements and their information needs. In this, different users look at financial statements for different purposes. For example, investors want profitability, banks want security, and employees want stability. Identify the purpose of the main financial statements. We will look at the income statement, second, statement of financial position, third, statement of cash flow, and statement of changes in equity. You will learn what each statement tells us. Define the elements of financial statements. We will cover the five core elements in which assets, liabilities, equity, income, expenses, these are the building blocks of accounting. Define and explain the main accounting concepts and characteristics. You will understand the fundamental concepts like accruals, going concerns, consistency, prudence, relevance, faithful representation, and others that guide the preparation of accounts. These objectives form the base for everything you will study later in financial accounting. This simple diagram you see here explains the entire flow of how financial information is created, processed, and finally presented to users. The two pillars of accounting. Accounting rests on two major elements, recording and summarizing. Let's break these down. Recording is the first and most basic function of accounting. This is where every financial transaction, every sale, purchase, expense, and income is documented. Think of recording as collecting raw data. Just like a factory collects raw materials before producing a final product, accounting collects financial data before creating financial statements. Second is summarizing. Once the raw data is recorded, accounting moves to the next step, which is summarizing. Here, the recorded information is rearranged, classified, and organized in a meaningful way. Right? The purpose of summarizing is simple: to convert thousands of transactions into clear, understandable financial reports. Right? What clear, understandable financial reports. And this summarized information forms the base for one of the most important tools in business, that is, financial statements. Now, before we go deeper into financial statements, notice another box here: management accounts. Management accounts are internal reports. Listen to me very carefully. Management accounts are internal reports used by the management team for decision making. They are not shared with outsiders. They help managers understand how the business is performing, what needs improvement, where to control costs, how to plan for the future. They are not published outside, they are not shared with outsiders. So, this is private. So, while financial statements tell you the outside world about the company, management accounts help the inside team run the company. So, this is the basic difference. Financial statements is the final output. All right. Now, let's move to the heart of accounting: that is financial statements. These statements are the final output of the accounting process. They are prepared after recording and summarizing all transactions. Financial statements are used by investors, lenders, regulators, and many others to understand the financial health of a business. The five main components of financial statements are shown in the diagram below. Right? The first one is statement of cash flows. This statement answers one simple question, that is, where did the cash come from and where did it go? Simple cash. No non cash items, only simple cash. When you study income statement and cash flow statement, you will understand the difference what is cash items and non cash items. All right. So basically, there are things that you have to understand when you do the income statement. You will have to recognize the revenue, even if you have done the sale in credit. So cash has not been received actually, but the sale has been done. So this has to be reverted in the cash flow statements. When you do the income statement and cash flow statement, you will understand in detail. So let's continue. It tracks cash movement under three activities. The cash flow statement, right? The first one is operating activities, investing activities, and finally financing activities. All right. So the second one is changes in equity, that is statement of changes in equity. All right, this report shows how the owner's stake in the business has changed during the period through profits, losses, dividends, or new capital. The third one is statement of profit or loss, also known as the income statement. It shows revenue, expenses, profit or loss. It answers, did the business really make money or not? All right. The fourth one is statement of financial position. This is what many people call the balance sheet. It shows the company's assets, liabilities, and equity at a specific point in time. Notes to the accounts. These notes provide extra explanations, details, and breakdowns that help users understand the numbers better. Think of notes as the behind the scenes details that clarify everything. So, to summarize, accounting starts with recording, then the information is summarized. Management receives internal reports, external users receive clearly structured financial statements. This full flow is what keeps business organized, transparent, and accountable. Every business, small or large, needs a system that records and summarizes its financial performance and financial position over a specific period of time. This information is not just a formality, it is extremely valuable for different people who depend on the business, right? Why accounting information matters? Many people, such as stakeholders, use accounting information to make important economic decisions. For example, if someone wants to buy shares of a company, the first thing they have to look at is financial statements. Investors deciding whether to invest, lenders deciding whether to give loans, management planning for the future, government and regulators checking compliance. For stakeholders to make good decisions, they need good quality financial information. That is exactly what an effective accounting system provides. What this chapter covers? In this chapter, we explore what businesses are, who their stakeholders are, what kind of information these stakeholders need, and how all this connects to the process of financial reporting. This chapter is an essential base for your future ACCA subjects, especially financial reporting. When you do financial reporting in skill level, these subjects will help you immensely, and strategic business reporting as well. Financial accounting versus management accounting. Let's look at the two branches of accounting. Financial accounting is all about preparing financial statements for external users such as stakeholders, shareholders, and investors. These statements show how well the directors have managed the company's resources, also known as stewardship. To ensure that companies across the world prepare their statements in a consistent way, we follow standards such as IAS, International Accounting Standards, IFRS standards, International Financial Reporting Standards, because financial statements are public documents. They present information in a summarized form. For example, they don't show the profitability of individual products. Where it comes to management accounting, serves a completely different purpose. Here, information is prepared for internal use for managers who run the business every day. This information is more detailed, more frequent, more flexible. Management accounting helps managers with formulating strategy, planning and controlling operations, making decisions, allocating and optimizing resources. These reports can be broken down by product line, department, region, whatever helps management understand and improve performance. So, to summarize, financial accounting provides standardized reports for external stakeholders. Management accounting provides detailed, customized information for internal decision making. Both are essential parts of a complete accounting system. With this foundation, we are now ready to move deeper into the process of financial reporting.